Welcome back to Management 720. We're going to get started on Chapter 5. Let's go ahead and let's take a look at the objectives. So before I get into the actual learning objectives of the chapter, we've just completed Exam 1 in the first 4 chapters. And so I want to explain a little bit more about the sort of the organization of the course. So we're taking 3 exams, each of them covering 4 chapters. These first 4 chapters, just to remind you, covered what I would call the short-term decision-making principles of managerial accounting. So each set of 4 chapters kind of covers a different look at costs, and with each different look at a set of costs, we have different ways of using those to do various things in managerial accounting. So in the first one, in the first 4 chapters, we looked at fixed and variable costs and allowed us to calculate contribution margin. This was the short-term decision-making model. And what did we learn from that? We learned how to predict total costs with the high-low model. We learned how to calculate break-even and what a target profit would be using both, calculating both the units necessary to break even or to get a target profit, or the sales volume to get a break even or target profit. And from there, we extended it to a couple of certain situations, such as what if you had a special order, what if you had a decision to outsource, sell as is, or with bottlenecks. And so all of those are based on, when I say short term, I mean decisions that are within the year, not long-term multi-year decisions. And this is sort of the first 4 chapters. I'm going to skip chapters 5 and 8 and just go to chapters 9 and 12 for a moment and say that those are the long-term decision-making chapters. And what are the costs that we look at? So in the first 4 chapters, we looked at fixed and variable costs. In chapters 9 through 12, we look at standard or standardized costs. And what can we do with those? What we can do with those are create budgets. And once you have a budget, nothing ever operates exactly according to budget. So when you make the budget at the beginning of the year and then you analyze at the end of the year or at various points in between, how far off are you from your budget? And we call those variances. So we make the budget and then we analyze variances to see what decisions, what corrections we can make. And one of the other big long-term decision making is when we need to buy new equipment, new buildings, new land, any sort of long-term asset, we go through a process of budgeting our capital expenditures, because those are typically big upfront dollar amounts that we put out there, and we need to make a decision on whether or not they are they're good value for us to be investing in. So that's the first 4 chapters and the last 4 chapters, short term versus long term. So what are these middle 4 chapters that we're embarking on tonight? The costs we're going to look at now are going to be product or manufacturing costs. And those costs are going to be DM, which stands for direct materials, DL, which stands for direct labor, and MOH, manufacturing overhead. So you see each set of 4 chapters has a different set of costs. Well, it's all the same costs, but they're just divided up in different ways. And so we're going to look at costs with the idea of how do we manage our costs from a pricing standpoint. And what are we going to look at from here? We're going to look at 3 sort of methods. We're going to look at job costing and process costing. That's going to be chapter 5. Activity-based costing, which is going to be chapter 6. And then there's going to be some additional details about various things in chapter 7 and 8. So tonight we're going to be looking at job and process costing. And this is part of the beginning of chapters 5 through 8, cost and pricing. So learning objective firm is these first couple of learning objectives, as you can see on the left-hand side, is going to be sort of introducing some of the basic information we need to know to where then we apply them in learning objective 4 and 5, where we actually get into the 2 models that we're going to be working on, job costing and process costing. So this first bit of information is to remind you that accountants look at businesses according to how they handle inventory, because inventory is such an important part of business and part of valuation and also expenses. So we have three different types. We have service firms, merchandisers, and manufacturers. From an accounting point of view, we say service firms are ones that do not buy and sell inventory. They're doctors, lawyers, that sort of thing. It's not to say that they don't have any inventory accounts. They could have supplies accounts or other sort of minor inventory accounts, but their main business is not to buy and sell inventory. So service firms have no primary inventory. Merchandisers, which is what we typically use as our example in financial accounting when we're learning about the financial statements, we use the word merchandiser because they buy and sell finished goods, meaning they buy a product as is, maybe in bulk, and then sell it individually, but they're not doing anything to change it. There is no value add. And so some people say, well, why don't you just call them retailers? Well, retailers sell to the end user, to the end customer, and wholesalers are business to business sales, but they both engage in the same objective. They buy things that are already completed and they sell them on and mark them up. So retailers and wholesalers are similar in that they only have one type of inventory, and that is finished goods. They buy finished goods and then sell them on as a markup. Now, in managerial accounting, we start talking about manufacturers, and they are a little more complex. And what is a manufacturer? There's someone that takes something, buys something, does some sort of value add, and changes it and then sells it on. So it doesn't have to be necessarily, oh, you're starting from coal or iron ore or anything like that. There are definitely some businesses that start with very primary materials. But when we say raw materials, a lot of times raw materials can be for like a car company. Maybe they buy from a specialty seat maker, they buy the seat component as one packaged thing, and then they put it into the car. So maybe they focus on making engines, but specialty parts of the car, maybe airbags or maybe the stereo system, they buy as a component. So buying things as components is still considered to be manufacturing when you're buying something, assembling it, and then selling it as something that was more than the sum of its parts before. So it doesn't have to be from scratch materials. It could be an assembler of purchased components. But the thing that makes a manufacturer stand out differently from a merchandiser or a service firm is that they have these three types of interlocking inventories. They start off with raw materials, and again, raw materials just could be components, or they could be iron ore or something very, primary type of raw material. Then you take the raw materials and you start to do something to them. That's the manufacturing or production part. That's what we call work in process. Now, remember that accountants see things in blocks of time, in increments of time, because we have to report on them, whereas managers see as a continuous flow. So a manager running a factory might think of, this is a production, I'm have a start and an end. But for the accountant, because the month end might come before you have finished some of your product, we need to be able to calculate what is the value of the work in process so that we can put that on the financial statements. And then, of course, there are also finished goods. So manufacturers purchase raw materials, then they work on them and work in process inventory. And then once they finish them, it goes into finished goods from which they sell it to other businesses or end users, depending on type, who their customer is. So in managerial accounting, we focus on the manufacturing costs. We cover sort of merchandising costs in financial accounting, and we cover the more, complicated version, the manufacturing costs, because it interacts with a lot of the other the other types of costs that we look at. So the first, definition of cost for this section is the idea that there are product costs and there are period costs. Product costs are going to be any and all costs incurred during manufacturing. It could be the materials used to build the product. It could be the labor used to to work on the product. It could be the supervisor that's supervising people, but inside the factory. It could be maintenance on the equipment, but inside the factory, or insurance or rent or utilities. And so we have a bunch of different costs, but as long as they are involved in the manufacturing process, somewhere within the factory walls, we call those product costs. And we'll see later on that we can divide it up in kind of a couple of different areas. So what is a period cost? Well, period costs are all the things that are essentially not product costs. Those are the other operating expenses. So what doesn't happen inside the factory? Well, sales doesn't happen inside the factory. What else? Advertising, delivery. You have senior executives at the headquarters. You have other things that are not involved directly with the manufacturing of the product, and those are called period. So non-manufacturing costs, and a lot of times you'll see them terms as sales, general, and administrative. You'll see in a lot of financial statements, SG&A, sales, general, and administrative. Commissions, advertising, non-manufacturing executive salaries, HQ expenses. And why do we call it period? Because they're reported on a period basis. In other words, when we, at the end of the month or at the end of the quarter, where we say, okay, this was all the rent or all the insurance or all whatever, or whatever these are the sales commissions, these were the advertising. These are the things that we would report at the end of the period, rather than product is reported on a product volume basis. In other words, all of these product costs are based upon how many products we made. So period is at the end of the period rather than on a product volume basis. Well, in managerial accounting, we're not so concerned with period costs, or at least how to manage those. We're more interested in managing the product costs. So the product costs, we go ahead and further divide into several areas. Now, the first sort of slice is there are going to be some product costs that are direct and some are indirect. And what is our definition of direct in this particular situation? Direct costs can be traced to individual items produced. In other words, if we're making a car, okay, we can say that these seats went into this car, this engine went into this car, this windshield went into this car, these tires went into this car. We have direct materials. We also have direct labor, people who are working on the factory assembly line. We can say this particular person worked for 45 seconds installing the windshield on this particular car, or however we split it up. But we can trace directly somewhat, the cost of some employee working on the product, and we can match it to the product. So we can properly cost the product. Of course, the idea of costing the product is so that we can then set a price later on. We can set a margin. So what are indirect things? They could be indirect labor, such as a supervisor's salary. In other words, a supervisor doesn't actually work on any particular car. They're overseeing all these cars. So if they oversee the production of 100 cars in a day, we take their daily salary and divide it by 100 cars, and we just apportion it that way. Other things, such as the rent of the factory or the utilities, those sort of things, we just say in this particular month, how many cars did we make? We take the rent and we divide it up and assign it indirectly to all these cars. In other words, we can't really trace the rent to each individual car because it's more of over a period of time. There can be indirect costs for materials as well. So just be aware that not only is there indirect labor, there are indirect materials. So for, say, lubricants or maybe car paint, things like that, when we paint all these cars, we may not track exactly the volume of paint that we put on each car. We just may say, okay, at the end of a month, we used up, however many gallons of paint. We then calculate how many different cars. Perhaps we had bigger and smaller cars, so we're not tracking, so individually. A lot of times indirect costs could be tracked directly, but it's not really worthwhile. And so you end up just saying, for example, when you're building a house, you may directly trace all the lumber that goes into the house because you know how many pallets of lumber you have and you know how many items are on the pallet. But would you directly trace how many nails? Or would you just say, okay, we built 3 houses this month. We used 50 buckets of nails. We're just going to arbitrarily assign however many buckets per house. So sometimes you could trace a material directly. It's just not worth your time, and therefore you do it indirectly. Also in Learning Objective 2, this particular textbook introduces the concept of predetermined overhead rates. Well, I don't quite exactly agree with how the textbook lays out all of the items that we need to learn for job costing and process costing. And so I'll do my best to follow the textbook, but I may have a slightly different kind of movement from the textbook. So okay, they try to introduce predetermined overhead rates. Let me introduce the bigger picture and then show you where predetermined overhead rates fit in. So we've just determined that there are period cost and product costs, and we're focused on product costs. And these product costs, we say, are divided into two general buckets, indirect and direct. And further, we divide those up into direct materials, direct labor, and manufacturing overhead. So we're focused on these three product costs: direct materials, direct labor, and manufacturing overhead. And what is the primary purpose of looking at these three costs? Understanding these costs leads to our ability to price. In other words, if we know how much it costs us to make it, we can therefore figure out how much we need to charge for it. But you have to remember, during a production cycle, we need to figure out the costs in real time to be able to price correctly. The situation is that some manufacturing overhead, some of the indirect costs, are not timely. In other words, maybe you only know the insurance at the end of the year, or maybe you only understand the utilities once a quarter, or there's plenty of different manufacturing overhead that you will not get on a timely basis. Now, obviously, the direct materials, as soon as you put them in production, you know how many materials you've used. As soon as you've had someone work on the assembly line, you know how many hours and how much per hour the labor works. So direct materials and direct labor, by their very fact they're direct, you can track them in real time. It's the manufacturing overhead that we don't know. Some of it we don't know for a long time after we've finished making the product, but yet we still need to price the product. So what do we need to do? We need to come up with a way to estimate our manufacturing overhead, to estimate some of these indirect costs, so that we have at least some number along with direct materials and direct labor, so that we can price and sell it. Now, a secondary purpose of knowing these costs is going back to the financial statements. Now, we've talked about inventory, and I may have mentioned that inventory and cost of goods sold are flip sides of the same coin. When we own the inventory, we call it inventory. When we sell inventory, we call it an expense. We call it cost of goods sold. So by understanding our inventory, we're able to, or we end up trying to figure out our inventory so that we can come up with two numbers. How much inventory did we sell? That's cost of goods sold for the income statement. And how much inventory do we have left? Well, that's ending inventory for the balance sheet. Remember, most of financial accounting is two things. We want to know how to increase or decrease various accounts, like how to increase AR, decrease AR. And then we want to know how do we value those accounts at the end of the period so we can put them on the financial statements. So we are primarily focused on these three costs: direct materials, direct labor, and manufacturing overhead, so that we can price correctly and timely. But a secondary purpose is we will end up knowing what the ending inventory and what the cost of goods sold as we do our calculation. So we have these three: DM, DL, MOH, and our costing method. There are going to be a couple of costing methods, depends on the product type. So the first one, for which predetermined overhead rate applies, is there's a job costing method. And what type of products are those? Unique items, such as homes, that are manufactured individually, and they're typically manufactured from start to finish. And there we know that what the direct materials are and the direct labor are, and we have to estimate these indirect costs, the manufacturing overhead. And we use a method to estimate the manufacturing overhead called predetermined overhead rate. There's a second type, and we'll be doing this one also in this chapter. It's called process costing. And these are for homogeneous items like shampoo, but it could also be things like cereal or anything that's like it's very not unique. It's a very similar item. In fact, it may be exactly the same, and it's just mass produced, but continuously. And so, if you're making a batch of shampoo, you're doing it in a big vat. You're not making each individual bottle of shampoo. You're doing a whole batch of shampoo, and then you bottle it separately at the end. So there's a couple of things that we need to know about process costing. They also have indirect costs, but we use a slightly different method because the product is different. Because the product's different, we use a slightly different way to estimate the indirect costs. And we call these indirect costs conversion costs. And we use a method called equivalent units. Of course, we'll go over that more once we get there. And just realize that there are products. Job costing and process costing is sort of two ends of the spectrum. There are lots of products that could sit at one or the other, or sometimes they're in between and you could choose a job costing method or process costing method. Like high-end cars like Ferraris or some other very specialty cars, those are unique items. They're built in small runs, and sometimes they're even built to customer specifications. And that's very different from low-end, high-volume cars, like they used to say about the Model T. Henry Ford said, you can have the Model T in any color you want as long as it's black, right? So the product you're making may end up, even though they're individual items, they may be so similar and so mass-produced and so continuous that they may fit a process costing process. Or you may have products that sort of sit in between, and then you make a decision to use a job costing or a process costing cost method, depending upon which one is easier or more suitable to your business. Okay, the last piece of preliminary information before we actually get into job costing is to talk about manufacturing inventories. So we were talking about the manufacturing costs, direct materials, direct labor, and manufacturing overhead just in the last slide. Here we're going to be talking about the various inventories. So the textbook for Learning Objective 3 basically talks about all the different types of paper documents, production files, and records. It's a very short learning objective, and I don't cover that because times have changed and a lot more documents are online, and so it's just not and even within the textbook, these sections have gotten smaller and smaller. So we're going to hold on to the idea of predetermined overhead rate for a moment. Introduce one additional thing that we need to know to be able to fully go into job costing, and that's going to be the manufacturing inventories. So we mentioned there are three types of interlocking inventories for manufacturers: raw materials, work in process, and finished goods. And that also goes through in time that way. You buy raw materials, you put them you start working on them, and then they become finished goods. So I want to introduce to you, and you've probably seen it before, but this is a very core concept in a lot of cost accounting and other parts of accounting. And that's the basic inventory equation. And you may have seen that when you studied financial accounting, when you looked at retail. And it goes like this: beginning inventory plus purchases equals COGS plus ending inventory. Well, we know what beginning inventory is. That's the inventory at the beginning of the month. Ending inventory is the inventory at the end of the month. And then we have the incoming items into inventory, and we have the items that are leaving inventory. For the basic inventory equation, it's we purchase things, that's how they get into inventory. And how do they leave? Well, they're sold. That's what cost of goods sold mean. That's inventory items that are sold. And so we say, and I want to kind of make the point that this is not that difficult a concept. And in fact, it's almost like a truism rather than an equation. So take these numbers here. If I said I have a small Ferrari dealership, I started off with 4 Ferraris at the beginning of the month. I purchased and was delivered 3. And then I went out onto the car lot at the end of the month and I counted the number of Ferraris that were left over after the month of sales. And I said, oh, there's 2 left. Well, how many Ferraris would I have had to sell? Well, if I started with 4 and bought 3 more, I had a total of 7. And if I only have 2 left, we're talking about a simple situation, not counting theft or something like that. I must have sold 5. So a lot of times in a lot of places in cost accounting, we use this equation and we sort of modify it based upon what we want to know. So as long as you know 3 of the numbers, you can figure out the 4th number. So sometimes you'll see beginning inventory. If you wanted to calculate COGS, for example, you might take beginning inventory plus purchases minus ending inventory, right? Just algebraically, you'd move that ending inventory over, and that would equal COGS. So, and there are different ways to, move one to the other depending upon what you're calculating. But the main thing, as long as you know 3, you can figure out the 4th. And I also point out a lot of times we use the phrase goods available for sale to represent the 2 items on the left side, meaning these, in other words, how many items could I have sold that month? I could have only sold 7 because I started with 4 and I bought 3. So at any one time, I had a maximum of 7 items I could sell. So we call the beginning inventory plus purchases, or whatever the phrase for the incoming amount is, we call those goods available for sale. Well, let's apply this basic inventory equation to the 3 manufacturing inventories. So we've got raw materials, work in process, and finished goods. So raw materials is beginning raw materials, that's what the RM stands for, plus purchases, we purchase raw materials, equals something plus ending raw materials. Well, how do things leave the raw materials inventory? It's when we transfer the materials to begin working on them. So we transfer them out of the raw materials inventory and we transfer them into the work in process inventory. So if we look at beginning work in process, we have beginning work in process inventory, all those things that we didn't finish last month. And then what do? We start working on them. Well, what are the 3 costs that we use to improve the work, or to, complete product, are working on the product? Well, we have 3 different types of costs. We have direct materials, direct labor, and manufacturing overhead. So if I were to draw a line, that transfer work in process would go down to the direct materials. Or I should say, because raw materials could be direct or indirect materials, some of them would go into direct materials and some of it go into MOH, but they would be added into the manufacturing cost. Now you may ask yourself, well, why don't we have a direct labor inventory? Well, labor is I would say on call. In other words, we don't put labor on the shelf. There is no inventory. There is no keeping inventory for future periods. And same with other indirect costs. So really the only physical inventory we have is raw materials, but that's just one of the 3 costs: direct materials, direct labor, and manufacturing overhead. We track direct labor basically on an ongoing basis. When people work, it becomes direct labor. And what happens from there? Well, we have ending work in process. That's the things that haven't been finished. And then we have a new word that we haven't seen before. So we know cost of goods sold, but those are things that we've sold out of our inventory. What do we call the things that we say we finished producing? In other words, they are no longer work in process. They are finished goods. We have finished producing them. Well, we call that category cost of good manufactured. And you can see that is the outgoing item from work in process, and it equates to the incoming item to finished goods. So we have beginning finished goods. What gets added to beginning finished goods? All those things that have completed manufacturing. Things that have completed manufacturing are called cost of good manufactured. And that's going to equal our ending finished goods. And then what things leave the finished goods? The things that we sell. Cost of goods sold. So if I were to say, look at the basic inventory equation, what was the first incoming item? Purchases. What was the outgoing item? COGS. If I look at raw materials at the beginning of the process, it's still purchases. And then if I look at the finished goods, what's the outgoing? COGS. So we still have purchases and COGS. We just have a couple of extra transfer steps in between. We transfer work in process we transfer materials into work in process, and we transfer finished manufactured goods into finished goods as a thing called cost of goods manufactured. And so those are the things that we need to know, and you hopefully will be able to keep track of these, because some of the homework questions and some of the quiz and exam questions are going to be focused on, I will give you 3 of these, I'll take the work in process or, raw materials or finished goods, and maybe I'll give you the beginning let's say finished goods. Maybe I'll give you the beginning finished goods, the ending finished goods, and the cost of goods sold. And then I'll ask you, well, how much is cost of goods manufactured? Well, a fairly simple equation. You just have to remember what it looks like. It's beginning finished goods plus cost of goods manufactured equals cost of goods sold plus ending finished goods. Okay, so now that we have the basic understanding of product costs, direct materials, direct labor, manufacturing overhead, let's go ahead and tackle the first of the two methods, the job costing method. Remember, job costing method is focused on unique items like building boats or building homes, building high-end cars, anything that's unique and that is done sort of start to finish. And remember, direct materials and direct labor are fairly easy to trace, and so we know those in a timely fashion. It's really, most of our work is going to be focused on estimating the manufacturing overhead, because some parts of manufacturing overhead come in later, such as, insurance expense or depreciation or other things like that. We may not know those for many months after we need to know the total cost to be able to sell it. So our job costing method is going to be focused mostly on estimating manufacturing overhead. Just remember, if the question asks what are the total costs, after you estimate the manufacturing overhead, you also have to add in the direct materials and direct labor. So we've got 4 steps. The first step is select a cost driver. Well, since we're not going to be able to know what manufacturing overhead is in a timely fashion, we need to choose something else that we think best approximates manufacturing overhead, or at least moves proportionally. And most of the questions at this level aren't going to ask you to actually select the cost driver, but just realize it's the first step. And remember, whatever the cost driver is not manufacturing overhead. It's just something that moves in the same direction in a similar fashion as manufacturing overhead, but it's something that we can track while we're producing the item, so that we can use it to calculate an estimate and then add that to direct materials and direct labor. So for example, if we have a labor intensive production, perhaps all the manufacturing overhead is we can calculate it based upon how many labor hours, and it could be like 20 cents for every labor hour is an additional manufacturing overhead, or it could be something more. It could be for every labor hour we have $10 additional of manufacturing overhead, but we're going to figure out what that number is. Let's say we have a machine intensive process. In other words, few laborers, but we're using a lot of machines. So therefore, maybe there's a lot of maintenance work and a lot of costs for lubrication or other types of things necessary to maintain the machines. So on that case, maybe labor hours wouldn't really be a good proxy for our additional costs, our indirect costs. Maybe something like machine hours, how long we run the machines, is a more of a direct relationship between manufacturing overhead and the costs for manufacturing overhead and the proxy we selected, which could be machine hours. The thing is whatever we select, it should be anything that we can track in real time, and it should move proportionally to the manufacturing overhead. So that once we've selected the cost driver, we're going to come up with a rate. This is going to be our estimate of a rate. And what do? This is where the predetermined overhead rate comes in. And that's why I was saying to introduce it back when they did was a little premature. I don't think they thought well enough to figure out they can't just throw this predetermined overhead rate without putting it in the context that it's part of job costing. So the predetermined overhead rate is before production happens. We don't know anything about our manufacturing overhead, but we may have either some idea from the previous years, or if we're still early in our process, this is going to be our best guess about manufacturing overhead. So we're going to say, we believe that this coming year or this coming production cycle, maybe it's a production month, our total estimated manufacturing overhead dollars is going to be this much. Now remember, total estimated. And then we're going to say whatever our cost driver is, let's say it's machine hours, we believe that we're going to run the machines X amount of hours. So what can we do? We can say, okay, we'll come up with a rate. We'll say whatever our manufacturing overhead is divided by the number of machine hours that we think we're going to run. We can say there could be X amount of manufacturing overhead dollars per one machine hour. So once we come up with this rate, and notice the rate is using total estimated on both the top and the bottom, both the numerator and the denominator. So step 1 and 2 are done before production happens. Step 3 is done while production has happened. Remember, we need to have some sort of proxy that allows us to track an estimate of MOH during production so that we can come up with costs so we can price it and sell it. So what do? Well, we kind of forget about our estimated hours, machine hours, and we say, okay, we have this rate. We're going to multiply it by how long we actually ran the machines. And that will be our estimate of the manufacturing overhead. And at this point, now that we have an estimate of MOH, what we're going to do is add that direct materials and direct labor to get a real-time cost estimate. Well, our guesstimate about MOH may or may not be accurate. So after the end of the production cycle, we're going to go back and evaluate. Were we good at estimating MOH? Now remember, direct materials and direct labor, we know it's MOH that we've estimated. So we're going to say, okay, did our estimate work out? Now, for the most case, it's never going to be exactly right, but as long as it's just a little bit over or a little bit under, that'll allow us to maybe fine tune our estimates going forward. So after you have the actual MOH dollars, then you compare. If the estimate that you calculated, we call the applied, is greater than the MOH, then we call that over applied. So just look at that. If the applied is over, we call that over applied. If the applied is under, we call that under applied. So it relates directly to the greater, lesser than, and the word applied. Now, I'll explain in the example, which we're going to look at next, that both of these have consequences. In other words, you want to be as accurate as possible, even knowing that you'll never be exactly accurate. You don't want to get wildly over applied, and you don't want to be wildly under applied. If you're over applied, you have the potential loss of market share, and under applied, which is actually a little bit more visible. It's a little bit more visible to see that you're under applied. That is an actual loss of profit margin. Well, let's take a look at an example of job costing going through these steps. So we have a company that has selected machine hours as its cost driver. And most of our questions at this level will be that the question has already selected what the cost driver is for you. Now, what most questions do not do is they don't use this before production, during production, and after production. What they'll do is just give you these estimates, the actuals, etc., etc. Now, a lot of times students get confused because they say, well, if I already know the actual MOH, why can't I just use that number? Well, it's because they haven't done a good enough job stating in the question that these bits of information don't all come in at the same time. You use the before production estimates to come up with your predetermined overhead rate. Then you apply it during production to the actual machine hours, and then you compare it to the after production actual MOH. So a lot of times that is confusing for people in the question when they're first starting out these questions, because they realize, well, if I got all this information, why do I need to do it in the estimate? Just realize that this is information that comes in at different points during the process. So what we know before production is the estimated total MOH, which is $500,000. The estimated total manufacturing machine hours, 25,000. So number one, select the cost driver. Question has already selected it. It's machine hours. We calculate the predetermined overhead rate. And remember, sometimes people put backwards the numbers. They put 25,000 over 500,000 or something like that. Remember, what you want to have is dollars per activity. So the dollars are going to be on the top. So here, 500,000 divided by 25,000. What we're saying is for every hour we run the machines, there's an extra $20. Our estimate is there's an extra $20 of manufacturing overhead involved. So what we do is we now take this rate of $20 and we say, okay, during production, I may have estimated that we were going to run our machines for 25,000, but we actually ran them for 30,000. You can see that during production, we actually ran the machines for 30,000 hours. Well, I'm going to take that rate and multiply it by the actual cost driver, not the estimate, but the actual. So I say $20 times 30,000 hours is, well, I'm going to use as my estimate of MOH $600,000. Now you can see up during production, we track total direct materials and direct labor. So our total manufacturing cost would be our estimate of MOH, which would be 600,000, plus those other two, which are 300 and 200, or 1,100, 1,100, 1,100,000. And we look at this here in just a second. So most questions in there, can you calculate the applied MOH? Some questions go further on, and I don't think I have any in here. I think most of my questions about over or under applied are just, do you understand the concept, or can I give you two numbers and you tell me if it's over or under applied? So here, at the top, we see after production, I have two numbers. I say actual MOH is 560,000, or a second scenario, what if it's 625,000? So we're going to look at both of those scenarios. Well, if our applied MOH was 600,000, that was our estimate. And we said, okay, during real time, we came up with a cost based upon our estimate of $600,000. We end up later finding out that our costs were 560. Well, our applied is over the actual, therefore it is over applied. Or if we took the second scenario and said, if we estimated 600,000, but it was actually 625, that's under applied. So let me see if I can give you an explanation of why neither one is good. So if I take my costs of at the time, what I had estimated was 600,000, and I'm looking at the very bottom of the page, the 600,000 plus the 300 direct materials plus the 200 direct labors, I would have come up with during production that my costs were 1.1 million. And if I said, based upon that, I want to make $400,000 in profit. If I want to make $400,000 in profit, I would tack $400,000 onto the 1.1 million and say, well, in total, I don't know if we're talking about a lot of different products or maybe one product, whatever it is, that in total, I should charge 1.5 million. Well, what happens if later on I find out that my costs were not 1.1 million because I had over applied? They're actually looking at the first scenario. If it was 560K, therefore my costs were 40K less than what I had estimated. So if I still went ahead and charged 1.5 million as a retail price, I would have made a little extra profit. Well, just keep that in mind, and I'll come back to that because that's the less obvious situation. Let's look at the second situation. If it was 600,000 as my estimate, but we actually had 625, well, you can see where my costs were actually more than I thought. So I thought it was 1.1 million and it was a little bit more. It was 25,000 more. And if I charged 1.5 million with the idea I wanted to make 400,000, I would have found, if we look at that second number in parentheses, I would have found that I actually only made 375,000. In other words, when I under apply, I lose margin. I wanted to make 400,000 and I tried my best to do that based upon my estimate, but my estimate was low and therefore I basically charged too little. I should have charged 1.525 million. So let's go back to the other one. You would say, well, I charged 1.5, my costs were lower, right? They were 560 instead of 600. So didn't I make more? Isn't making more good? Shouldn't I always over apply and make more margin? Well, this is why one of them is a guaranteed loss of margin. That's the second one, the under applied. Whereas the over applied is a little bit less intuitive or a little less straightforward. Let's say there's another company out there that's better at estimating their costs. They're more accurate. And so for the exact same product or products, let's say we thought our costs were 1.1 million. We charged 1.5 million as a cost. But the other company that was better at estimating costs, maybe they said, we're going to charge 1.46 million. In other words, they're going to undercut us. Now we may think, they have too little margin, but really, if they were better at estimating their costs, they could charge a more accurate price, still make the amount of profit they want, and we would have overcharged. We would have set our retail price too high and then perhaps lost market share to the people who were better at estimating costs. Now, that's not guaranteed because, sometimes the margin for error is small enough that small differences in price are not that big a deal, but you don't want to chronically over apply and just say, hey, if we miss the number, but we miss the number high, we just make more margin. Well, it could be that you miss the mark, you charge too much, and competitors come in and undercut you, and therefore you lose market share. Anyway, that's the rationale of why you don't want to over apply or under apply. You want to try and hit as accurately as possible, even though you don't always, you hardly ever hit the number exactly right. Okay, now we move on to the second type of costing method. And so job costing was for unique items. Remember, process costing is for homogeneous, continually produced items such as shampoo or cereal or things like of that nature. There are two differences when we move into process costing. Remember, in job costing, we focused on direct materials, direct labor, and manufacturing overhead, and we estimated manufacturing overhead using the predetermined overhead rate. Difference number one with process costing is whereas under job costing, each individual item might be built start to finish. You would go all the way through, build the item, finish it, then start on another item. Typically, process costing products are done in stages. For example, whiskey. You would have a bunch of, you don't make individual bottles of whiskey, you make a batch of whiskey. And what do? You take all of your ingredients, you put them in, and they start to ferment. And then you move the ferment, once the batch has completed the fermentation stage, you'll move it to the distillation stage. And then when it's all distilled, you move it to the aged, in the cask stage. Now, I know there are other steps in this whole process, but the idea is that you're moving a batch of items from step to step. You're not making one bottle from start to finish. You're making a whole set of bottles or a whole batch in stages and moving them through the stages. Well, what's the result of this? Rather than having one work in process account, you have multiple work in process accounts because each of these stages are different work in process stages. So you may have a fermented work in process, a distillation work in process, an aged work in process, and you would be managing the different batches as they move through these. So process costing has multiple work in process. Job costing typically has one work in process. The second difference is, well, within the batch, we know how many materials we put in the batch, how much corn or mash or whatever it is that we use for the whiskey, that we know the materials, but again, the labor is not as direct as it was with the other unique items. We know from the factory line how long different workers work on different items. We can track that and we can attach those costs directly to the items. In a process costing environment, it may be several workers working on several batches at different points, and it's much harder to trace labor input directly to the batches or directly to individual items. So what we end up doing is we say direct labor sort of becomes indirect labor now. It all becomes indirect. And we pair that with manufacturing overhead, and we call this category a new category. So we have direct material, and then we have the combination of direct labor and manufacturing overhead. We call these conversion costs. In other words, these are all the things that go into converting the direct material into a finished product. So it's still DM, DL, and MOH. It's just that in process costing, we can't differentiate direct labor anymore, so we just slide it in with MOH, and we call the combination conversion cost. But it's still the whole process. Our whole process costing is just like with job costing. Our most important thing is that we don't know what the indirect costs are, so we need to estimate them. Under job costing, we estimated the MOH with the predetermined overhead rate. With process costing, we estimate the indirect costs, the conversion costs, with something called equivalent units. And what is an equivalent unit? Well, not to go into too deep idea, remember we're talking about work in process. So there are some work in process items that are more complete, some that are not complete. Well, we want to have a way to figure out what are the direct material costs and what are the conversion costs, but figure out in such a way to where we're only dealing with a sort of the equivalent of completed units. So what do I mean by that? Well, take, for example, if I say, okay, we have 4 full-time students and 2 half-time students. Aren't 4 full-time students and 2 half-time students the equivalent of 5 full-time? Because the 2 half-time students sort of equate to 1 student. So if I were trying to figure out, well, how many hours do I need from my, the mentoring program or for the dining hall? And they say, well, we base this on the number of full-time students. Well, not every student's a full-time student, but I could say a full-time equivalent student. So I figure out a number based upon the number of full-time students and the number of half-time students and come up with one number. And that's what we say, as long as you serve X amount of students, that will cover both the full-time and half-time. Well, we do something similar with process costing. We try and convert direct materials and conversion costs into full-time equivalents and then figure out how to price them that way. So just, I guess, as far as theory, the way that process costing works is based upon the inventory equation. Remember, the inventory equation was beginning inventory plus purchases equals cost of goods sold plus ending inventory. So what ends up happening is that the beginning inventory and purchases, we know the dollar amounts. And the cost of goods sold and the ending inventory, we know the direct materials and conversion costs. So because the left side must equal the right side, we are able to transfer through this process the dollars from the left side of the equation. We can transfer those to become dollars on the right side of the equation. And that's essentially what process costing is, how to apply the dollars we know to the unknown ending inventory and COGS. And we use process costing as that way. And we track it in these two categories, the direct materials and the conversion costs. Well, that all seems very abstract, so let's take a look at an example. So here's an example, and just to remind ourselves, what we're trying to do is take the dollars we know from beginning inventory and purchases and transfer those over proportionally to the COGS and ending inventory. So even though I've set them up in tables, sometimes the information comes in tables, sometimes they come in sentences, but you can always put them in these couple of tables. So for the beginning and started, I should say purchases in this particular example, when we're talking about work in process, we're talking about started. So it's beginning work in process, and instead of the word purchases for work in process, we use the word started, because started are the new items in the situation, and completed items are the ones that leave the inventory. I should say started items enter inventory, completed items leave inventory. So they're the equivalent of purchases and COGS. So what we would typically know is the beginning work in process. And I'll just throw out there, you notice I have in that first table X%, because they always try and throw out a percentage of the beginning work in process. That relates, we don't need to know that to calculate things. And so I'm almost intentionally saying, you don't even need to know it. Even though they give you that number, that's okay. Don't worry about that. That doesn't help us solve the problem. So they say, okay, beginning work in process has $40 in direct materials and $20 in conversion costs. During the month or during the period, we started a number of other items, and the breakdown between direct materials and conversion costs were 24 and 19. So what we need to do is we need to add up the direct materials and we need to add up the conversion cost dollars. So between beginning work in process and started, it's $64 for direct materials and it's $39 for conversion costs. On the right side of the equation, the cost of goods sold. Now remember, cost of goods sold here, we're going to be calling completed units. Remember, cost of goods sold is just anything leaving inventory. Completed for work in process are things that are leaving inventory. So completed and ending work in process. If we just read the sentence, it says we completed 10 units and ending work in process is 50% complete for 6 units. Now notice the small box I have on the side. By default, the word completed indicates that all the materials have been added and all of the conversion costs have been added, right? So for something to be complete, it has to have all the materials and it has to be fully converted. So when I say completed units, it's going to have all my direct material units and it's going to have all my conversion cost units. Now, an equivalent unit, this EU, is not a dollar amount. It's just something we've broken down into an abstract unit. Now, ending work in process, and for these managerial accounting questions, they take more of a basic approach and they say, as soon as you start a product, you've added all the materials. Now, there are more difficult accounting. If you get into higher level not that you are, but for high level accounting, there are sometimes certain processes where the work in process does not start with all the material, that you add it proportionally. But for our questions in our homework, we're going to assume that if you have started a product, if you started making something, you have taken all the materials out of storage, out of the raw materials inventory, and placed it at the production area. So the only thing that's not finished is the conversion cost. You have all the materials. If it's work in process, you have all the materials, but you may not have completely converted it. So when we say ending work in process, that there were 6 units, well, it must have had all 6 units of materials. But so the only thing that the 50% complete refers to is it's 50% complete as referring to the conversion cost. So look at the little box. 3 of the boxes are 100%, and only 1 box is whatever the percent is that says on the question. So completed, if it says there's 10 units completed, it's 10 units of DM and it's 10 units of CC. Any work in process, if there are 6 units, that means 6 units of DM, and then only apply that 50% to the CC. So what do we do? Again, adding down. How many direct material units are there in the right side of the equation, in the completed and ending work in process? 16 units, or 16 equivalent units of DM. And if same with CC, there are 13 units of CC. So we take the dollars that we know from above, the total dollars for direct materials was 64. We divide that by the 16 total units for direct materials, and we come up with a rate of $4 per direct material. And same with the CC. Ends up being 39 total dollars divided by $13, $39 divided by 13 units of CC, or $3 per unit. So we then take these per unit costs and we apply them again to, remember the whole idea is we want to take the dollar amounts from beginning inventory and purchases and apply it to the completed and ending work in process. So I take looking at the bottom chart, I take the 10 units of direct materials times $4 per direct material. And I take the the 10 units of CC times the $3 per CC. And you can see that's 40 plus 30 equals 70. And I do the same thing with ending work in process. 6 times 4, 3 times 3 is 24 plus 9. And I add those down. Now, if one way to double check it is, you can see that the total dollars in completed and ending work in process is 103. And if we go up to that same red number, it's 103. In other words, it may have been apportioned differently between beginning work in process and started, but the same amount of dollars that we began with gets transferred to the other side of the equation, just in a different proportion. It's 70 versus 33, whereas the top one is, 60 versus 43, I guess. So we have conserved all the dollars. All the dollars have moved across. All we did was use the equivalent units to see how do we divide up that $103 between completed and ending work in process. Now I imagine, you probably will end up going back and listening to this example maybe once or twice, and that's fine. Let's take a look at the absorption and variable costing, and then we'll move on to homework. Now, technically, Learning Objective 6 is an appendix, and I'm not going to test on any calculations in it. I just want you to understand the concepts. And we've actually covered these concepts before. We're just applying slightly different names to it. So we looked previously at the difference between a contribution margin income statement and a GAAP income statement. Well, that's what we're talking about, but now we're phrasing it in the terms of costing. So a GAAP income statement, you can see here is the top one. Sales minus cost of goods sold equals gross margin minus operating expenses equals net income. We call this absorption costing or full costing because we are required by GAAP to, whatever the cost of goods sold is, we have to apply all the manufacturing costs to the cost of goods sold. They have to be included. All the manufacturing costs have to be absorbed by these 3 inventories. And that's why it's called absorption costing. But notice the breakdown. Cost of goods sold. Remember, cost of goods sold, this is, if you look at the top, this is the difference between product, and period costs. COGS are all the product costs, and operating expenses are all of the period costs. So in COGS, we have the fixed and variable manufacturing costs. In operating expenses, we have the fixed and variable sales, general, and administrative. So what we're doing is we're dividing the costs along product versus period. Now, in the variable costing, what we call the contribution margin income statement or direct costing, we're taking those same expenses, but we're dividing them again along a different line. We're dividing them variable costs versus fixed costs. So it comes out to the same, or depending upon the complexity of the equation, it comes out to the same over time. Sometimes there's a little bit of timing differences, but it's sales minus variable costs, but those are variable manufacturing and sales, general and administrative, equals contribution margin minus fixed costs, which is fixed manufacturing and the sales, general, and administrative, equals net income. So when we talk about absorption, it's product versus period. When we talk about variable costing, it's variable costs versus fixed costs. So just understanding that the absorption is the GAAP required one. The variable costing is what we do to help us manage our costs, but is not GAAP compliant. Okay, like we've done in the last couple of videos, I'm going to go through the homework items, or some of the homework items that require calculations. Obviously, there's a bunch of other questions that are knowledge-based questions, and I'm relying upon you to do your reading, or to however you want to figure it out, that you should be able to understand the sort of knowledge and definitional based questions. Just for FYI, the homework items I'm going over are number 2, 3, 8, 9, 11, 12, 13. And let's go ahead and switch over to the My Business Course software. Okay, so here we have question number 2. And this we're given some information. We're given raw materials, work in process, and we're asked to calculate. Let's see, we're given some other. Well, we are given some other information. We're asked to calculate a few different items. So let's go ahead and take a look at the preview of the question. And well, I wish they wouldn't send this way over here. Let's see. Determine each of the following. So let's look at so number 2. A, cost of raw materials purchased. So essentially what we're going to be doing here is we're going to be looking at a bunch of different inventory questions, being able to know the inventory for beginning inventory plus what equals what. So we're going to do a bunch of these. So this is the equation for cost of raw materials. So we have beginning raw materials plus purchases equals what we transferred out plus any raw materials. In our little table here, we see we have beginning raw materials of 70,000, any raw materials of 80,000. If we scroll over, it says 400,000. What is that? It says raw materials used. Well, put into production. So that's the transferred out. So 400 plus 80, 480 minus 70 should be 410. So our first one here that we're going to do is 410,000. Let's take a look at the next one. So part B says direct labor costs charged to production. I started charting out the inventory equation, but reading the question, it doesn't actually ask that. Anyway, so here's beginning work in process, the 85 and the 40,000. But let's see what it does say. Total manufacturing costs charged to production during the year. Now remember, that's direct materials, direct labor, and manufacturing overhead. So we already know the raw materials used. So it says 681,000. If I'm reading this correctly, they're saying these three together add up to 681. And they're saying we've given you raw materials, which is 400,000. So 400,000, so if I take away 400,000, 281. 281 equals these two combined. And what they're asking is, what is just direct labor? So direct labor plus something equals 281. Well, what's the information they give us? They say manufacturing overhead applied at a rate of 60% of direct labor costs. So what goes into this 281? It says it's direct labor costs plus the manufacturing overhead. But they say manufacturing overhead is 0.6 of direct labor. So what we have is 1 plus 0.6. 1.6 direct labor equals 281. So direct labor should be 281 divided by 1.6. So let's figure that out. 281,000 divided by 1.6 equals, well, kind of an odd number, 175,625, but at least it's a whole number. So we would go up here and we would say, oh, you didn't quite see all of that. 175, and we'll check this here in just a second. Hopefully that'll be good. So we've got that. Let's move on to the next question. So question C, or part C, is asking us, just like question A, it's asking us for one of the items. So we know from the beginning and ending inventory that we've got work in process beginning and ending of 85 and 40. We know what was added, which was 681, and what they're asking is, what is cost of goods manufactured? Cost, remember, that's the amount that has been completed and moved on into finished goods. So this should just be 681 plus 85 minus 40 equals 726. And that's what we'll put here. And so this final one, cost of goods sold, is looking at the final inventory. So you can see up here at the start, we looked at raw materials. We looked at a calculation just within the chart, the costs, direct material, direct labor, manufacturing. Then we looked at a work in process question, and now we're looking at a finished goods question. So we'd already calculated the 726. That's the cost of the goods manufactured. And we know what the beginning finished goods are and the ending, so 90 and 110. They also give us this 816 here, which they say is goods available for sale. Well, let's just double check. 90 plus 726 is 816. So why they give it to us a second time, I guess maybe in case you were getting this number wrong, it's sort of a way to double check. But if we calculate this out, well, if you notice, 90 and 110, it's 20,000 difference. So in other words, this number has to be 20,000 less for these two things to be equal. So this has to be 706. So we put 706,000 in here, and let's check. All good. And of course, your numbers are a little different, but the process should still be the same. Okay, we're going to look at question number 3, and we'll preview the question. Now here, you notice we've got several case A, B, C, and D, and we're given various items, and this is just to practice what is the relationship between the different items. So if I would just do this first one, remember total costs, the total direct costs are the direct materials and direct labor. So this should be 60,000. Conversion costs are direct labor and manufacturing overhead. So it should be 15 plus 24 or 49,000. Current manufacturing costs are going to be direct materials, direct labor, and manufacturing overhead. So it'll be the 45, 15, and 24. So 4, 5, 6, 7, 8, 84,000. Is that right? I'm just doing this in my head. And cost of good manufactured. Well, here we would figure out work in process, beginning, work in process, ending. We would say all of the current manufacturing costs, the 84,000 is what gets added to it. So if I do the work in process, remember beginning work in process plus manufacturing costs, which are the three, has to equal cost of goods manufactured plus ending work in process. So our beginning work in process here is 21,000. The manufacturing costs are 84,000. Cost of goods manufactured is what we're looking for. Any work in process is 15. And so 21 plus 84 is 105 minus 15. It's going to be 90. So that should be 90,000 here. And cost of goods sold. Well, you do the same thing, except with the finished goods. You'd have finished goods, beginning finished goods, plus cost of goods manufactured equals cost of goods sold plus ending finished goods. So beginning finished goods is 27. Cost of goods manufactured, we calculate it as 90. Cost of goods sold is what we're looking for. Ending cost of goods, ending finished goods is 18. So this is going to be 107 minus 18. So I'm going to guess that's 99, or let's see, 89. Let me just double check. 89. Gross profit. So we take sales of 255,000. Remember how we get there. It is sales minus cost of goods sold equals gross profit. So 255 minus 80. Oh, darn it. 255,000 minus 89,000 equals 166. Minus selling, because remember our thing is sales minus COGS. For the regular absorption costing is gross profit or gross margin, whichever one you want to use. I tend to say gross margin more often. Minus operating expenses equals net income. And so 166 minus this, 106. And if I check, well, it's going to say all these are wrong, but at least you can see their relationship. These should be correct. Ew, so conversion cost, I somehow did incorrectly. Let's take a look. Conversion cost should be direct labor plus manufacturing overhead. Oh, I was going too fast. 39, right? 24 plus 15 is 39. So somehow I added those correctly. Cost of goods sold, somehow I did a miscalculation here. So if we say finished goods inventory beginning is 27, cost of goods manufactured is 90, finished goods inventory ending is 18. Well, isn't that right? 90 plus 27 equals minus 18. Oh, again, I miscalculated in my head. So this should be 99,000, and therefore this should be 255 minus 99 equals 156. So there you go. A few numbers throw us off. Then minus 60 is going to be 96. But I was on the right path. Okay, so check. So all of those are right. So basically, you just do the same other columns, but with now that you understand the relationships, you can figure out all the other numbers. And this is good practice for all of them. Okay, let's take a look at number 8. This is a simpler equation. Again, how they do the homework in this book is kind of haphazard. I prefer when they show the simpler ones first and they work up to the harder ones, but here they're kind of mixed up. I could possibly do a better job of arranging them. But really how I've arranged them is I've arranged them according to learning objective rather than easy to hard or knowledge versus calculation questions. Let's look at this question here. So the balance in the work in process inventory account. So again, all we're doing is practicing these different types of inventory accounts. Work in process, beginning. Now you notice here, it doesn't say beginning work in process, but it says April 1st. April 1st is the beginning of the month, and the other one they give is April 30th. So April 1 is beginning inventory, April 30th is ending inventory. So plus manufacturing costs equals cost of goods manufactured plus ending work in process. So beginning work in process is going to be 29,480. Ending work in process is going to be 24,860. The direct costs, and I would add those up, 45,375, 23,430, 35,860, and 860, whatever those are. This plus this minus this is going to be cost of good manufactured. Now you notice they don't call it cost of good manufactured. They say it's transferred to finished good. But that's what cost of good manufactured are. Those are the completed work in process items that go into finished goods. So let me go through the numbers here and see if I got them. So what I did was this plus all these three minus this one equals this. So, and it's always nice when you have a weird number and it's one of the options. Check. Okay. Let's go on to question number 9. And this is an important one because all the questions up to now have been various calculated inventory. Do you understand the 3 types of inventory and how to move from one to the next one? This is our first and really only calculation question based upon job costing. Now remember, job costing looks at unique items, and how we do it is we have direct materials, direct labor, and then we estimate the manufacturing overhead using the predetermined overhead rate. So this one should be fairly straightforward. Remember step A, well, in my process, step number 1 is determine the cost driver, but they've determined the cost driver for us. It's machine hours. And so the next thing we do is figure out the predetermined overhead rate. Now remember, that process is that is taking the total estimated. Now see here, assume the following predictions. So even though it doesn't say estimated in here, these two numbers are the estimates. So the total estimated manufacturing overhead is 40 million, number of machine hours. So what are we saying? We're saying it's 40 million divided by 2 million, or $20 per hour. Use the predetermined overhead rate per machine hour, determine the applied. So that's taking this rate times the actual machine hours. So the actual machine hours were 310,000. So 20 times 310,000 is going to be 6.2 million, right? And then it says determine, okay, so they got kind of a little wonky thing here. As of February 1, actual overhead was underapplied by 500,000, determining the cumulative amount of any over or under applied. So first of all, they're saying January 1, whatever the calculation was, this is complete. We could say this is over and this is under applied. So what they're saying is in January, the under applied was 500,000. So what we're going to figure out is for January 31st. So let's just call it January. So for February, for all of February, we're going to say it was 6.2 million is the applied versus the actual manufacturing overhead of 5.48. So is it over or under applied? Well, it's definitely over applied. By how much? Well, we subtract 6.2 minus the 5.28. So 6.2, or let's say 6,200,000 minus 5,480,000 equals, it's over applied by 720,000. So for February, it is 720 over. But it's not asking you what was the amount for February. It's saying if we take both months together, what is the net effect? What is the cumulative effect? Well, if we were 500 under and 720 over, the net effect is we're going to still be, this is a 7. We're still going to be, well, 720 minus 500, we're still going to be cumulatively 220 over, I think is what they're asking for. Let's check. And that's what they were looking for. So a little bit tricky on C. So just realize what they're asking for. We're going to look at question 11, and if I remember right, yes, this looks like a knowledge question, but it's really an analysis question. So what are they really asking us here? What they're asking us here is, do you understand what increases and what decreases the various types of inventory? Well, remember, work in process is increased by what? Direct materials, direct labor, and manufacturing overhead. What decreases? In other words, the things that come into work in process are all the manufacturing costs. The things that leave work in process are all the completed items. So which of the following would increase work in process? Selling finished goods? Well, that has to deal with the finished goods inventory, not the work in process inventory. Using direct labor hours. Direct labor hours is one of the things that increases work in process. Finishing a job in process. Well, that's what gets transferred to finished goods. So that would decrease work in process. And purchasing raw materials only has to deal with the raw materials inventory. So these two, B and C, are the ones that deal with work in process. A deals with finished goods. D deals with raw materials inventory. But of these two, the finishing a job in process decreases work in process, while adding direct labor hours or direct materials or manufacturing overhead are the things that increases. So this is more of an analysis. Do you understand what increases and what decreases each of the three different types of inventory? Okay, we're going to look at 12 now. And this is, so that the previous, not the last one, the one previous, that was the one job costing one. And now we're back to looking at being able to analyze inventories. So here we have the following information. Sales, beginning finished goods, ending finished goods, cost of goods sold. The cost of goods manufactured this period equals. So remember, what is our equation? It's beginning finished goods. What is coming in? Things that were completed from the work in process, which is called cost of goods manufactured, equals what leaves finished goods, things that we sell, called cost of goods sold, plus ending finished goods. So we have beginning finished goods of 12,000. We have ending finished goods of 8,000. We have cost of goods sold of 9,000. So you can see pretty simply, this is 17, this is 12. Cost of goods manufactured must be 5. Did we even need the sales? Well, if the question had something to do with profit or something like that, we may have needed. But here, all we needed was this 5,000. Our last question we're going to go over is question 13, and this really is the only process costing question that we have in the homework, or at least calculation. So it looks a little hairier than it should be, and that's why I don't really like how a lot of these textbooks handle it. If you go back to my instructions about the example that we did in process costing, that's how I'm going to essentially do it for the quiz and the homework, but you should be at least able to identify what's going on here. So let's go ahead and look at the preview question. Okay, so we have work in process. Now remember, sometimes they don't say beginning or ending. You have to look at the dates. So this is beginning work in process. This is ending work in process. Now, remember I said what we want to do is we want to take the beginning and incoming dollars and transfer that to the completed and ending units. So that's essentially what we're going to be doing here. So let's take a look at what we've got. Units completed. Units completed is 20,000. So 20. Now remember, by default, if a unit is completed, it's completed both for materials and for conversion costs. Plus equivalent units in ending inventory. Ending work in process is 5,000. And remember, so this is 100% of the number, 100% of the number. Materials for the ending is 100%. The only number that's different is going to be the conversion for the ending units. You can double check that with what we did in the example. So 75% of 5,000 is going to be 0.75 times, is that 3750? It is 3750. 3750. So when I add it up, the total materials units are 25,000 units. So you notice they're doing it sort of backwards from how I did it. I did the dollars first, then the units, then applied it. They're giving us the total units, and then we're going to calculate the dollars, then apply it. So the total conversion, and that's part of doing these homework questions, is that how the textbooks present it is usually a little too complex. How I present it is usually pretty straightforward. And then how the question, you sort of have to take what you've learned from watching me do it and be able to interpret it. So this is sort of a critical thinking exercise, being able to apply knowledge in a slightly different format. Okay, beginning work in process dollars. So if we look at the cost data, it says raw materials transferred to processing, conversion costs. So essentially what it looks like they're saying is there was no beginning work in process. Oh, so I can look here. There were 0 tons beginning work in process. So there were $0. This is sort of an unusual question. There was 0 material dollars and 0 conversion cost dollars. So there are total 0. So all we have are the costs that were added. Raw materials transferred to processing. So the current raw materials were 812, 500. And then it says conversion costs. Well, you notice they don't give us one of the number. They only give us part of the number. They give us 59,375. And then they say manufacturing overhead rate is applied at $6 per equivalent ton. Well, they're not super clear, but I'm going to guess they mean $6 per equivalent conversion cost ton, per equivalent units, because they're talking about the equivalent unit, not the actual tons. So the equivalent units is 23,000. So what I'm going to do is multiply 6 times 23,750, and then I'm going to add the 59,735. So let's do that. 6 times 23,750 plus 59,375 equals 201,875. Let me just make sure I did that right. 6 times 23,750. Oh, no, that looks about right. Plus 59,375. Okay. So what are our total costs going across? Is going to be plus 2,500 equals going to be 114,375. And then the total cost, the 0 plus 812, well, that's just 812,500. 0 plus 201 is 201,875. And this should be 104,375. Now, equivalent units in process. So 25,000. 23,750. So we're dividing the dollars per equivalent units to get, so let me do 812,500 divided by 25,000 equals 32.5. And this one is 201,875 divided by equals 8.5. So therefore, it's a total of $41 for the total cost. Now here, transferred out, so completed. How many units were completed? 20,000 units. Now, if I could do 20,000 times 32.5 plus 20,000 times 8.5, but because they're both being multiplied by 20,000, I can just do 20,000 times 41, which is the total cost. 20,000 times 41 equals 820,000. Now, the materials would be for the ending, so we're looking at ending work in process. The ending materials is 5,000 units times 32.5 equals 162. And the conversion costs are going to be 3750 times 8.5 equals 31,875. And if I add those two numbers together, that should be the total cost in ending work in process equals 194,375. And if I add the completed costs plus the ending work in process costs equals 101,4,375. And that's again our double check. We said the beginning work in process of 0 plus all the current costs was 101,4,375. Once we applied the equivalent units, we came up with the transferred out or completed units was 820. Ending work in process was 194. And again, that added up to this. In other words, all we did was transfer the beginning dollars to the ending units and came up with the same dollar amount. So hopefully that checks, and it does check. Okay, that should be all we have going on here. This one's a little longer. It's about an hour and a half, but it is a lot of information. Typically, managerial accounting textbooks split up job costing and process costing into two chapters. This one put it together. That's why it's a little longer. But don't worry, the next chapter is a little less, and then chapters 7 and 8 are more just definitional and informational, a little less calculation. So this really was the big chapter. Okay, thank you. And if you have any questions, let me know.